Good evening and thank you for watching. This is my presentation on Chapter 7, Accounts Receivables. The gross method versus the net method. The gross method records sales at their full value and yields a higher initial net value. These transactions are recorded without their discounts initially. The net method records sales at their discounted value, which leads to a lower initial net value. The cash discounts are later taken out. Walmart offers 5% discount for early payment of $25,000. These terms include a 2% off within 10 days or a net price within 30 days. The gross method shows that we would debit accounts receivable and credit sales revenue for the full price of $25,000. The net method shows that we'll debit accounts receivable and credit sales revenue for $23,750. This value includes the discount. Now, let's assume you pay part of the price within 10 days. The gross method shows that we'll debit cash and sales discounts and credit accounts receivables. As you could see, the sales discounts are recorded in their own account. The net method shows that we'll debit cash for $16,625 and credit accounts receivable for the same amount. Now let's pay for the rest before the 30 days is up. The gross method shows that we'll debit cash, credit accounts receivable for $7,500. But the net method shows that we'll debit cash for $7,500 and credit both accounts receivable and the sales discount forfeited. Although these two methods are different, they're presented differently, ultimately at the bottom we can see we still have the same value for the net sales revenue. The allowance method. This is required by GAAP when the bad debts of a firm are material and impact the financial positioning of a firm. The allowance for uncollectible accounts is a contra asset account, which reduces the accounts receivables to the amount of cash a firm expects to collect, also known as the net realizable value. On the balance sheet, we would see the net value of accounts receivable. If we add to that the allowances for uncollectible accounts, we will have the gross accounts receivable. The bad debt expense is recorded at the period end when adjusting the allowance for bad debt. When an account is guaranteed as uncollectible, both the accounts receivables and the allowance account will be reduced and there will be a write-off for the receivable. To the side, we can see some examples of adjusting journal entries. An adjustment to increase the allowance at a period end includes a debit to bad debt expense and a credit for allowance to doubtful accounts. In some circumstances, the period end adjustment will need to decrease the allowance. Allowance for doubtful accounts will be debited and bad debt expense will be credited. A write-off occurs when a specific account is identified as uncollectible. This means we'll debit the allowance for doubtful accounts and we'll credit the accounts receivable. Then the item will be written off. So an exercise for the allowance method is shown here. The trial balance before adjusting entries shows the following balances. Accounts receivable is $180,000 and allowance for doubtful accounts is $8,500. In analyzing the outstanding receivables, it was determined that 11,000 of accounts need to be written off. After the write-off, the company believes 4% of remaining gross accounts receivables will be uncollectible. Provide the required journal entries for the write-off and the adjustment to the allowance. Step 1, record the write-off. For this, we will debit the allowance for doubtful accounts of 11,000 and we will credit the accounts receivable for 11,000. The next step is to adjust the allowance. Using this method shown here, we will first look at the credit balance prior to write-offs or year-end adjustments, which was $8,500. We will then reduce it by the write-off amount, which was $11,000. That leaves us with a balance before year-end adjustments of $2,500. Our desired allowance for doubtful accounts is $6,760. That means we will have to add an adjustment of $9,260 to have the desired allowance for doubtful accounts. We received $6,760 by looking at the desired ending balance. We have a balance in accounts receivable of $169,000, which we know because we had $180,000 first and we reduced it by $11,000 after the write-off. We multiply that by 4% because that's the estimated remaining gross accounts receivable that will be uncollectible. That's how we got $6,760. The journal entry is going to be a debit to bad debt expense of $9,260 and a credit for allowance for doubtful accounts. Now I will show you a sales discount exercise. The problem is this. ABC Company offers credit customers terms of 3% off within 15 days or a net price of 30. On October 5th, 2021, ABC sold merchandise on credit at a price of $10,000. The customer paid $6,790, which was $7,000 less the 3% cash discount on October 19th and the remaining balance of $3,000 on November 4th. First, we must record the sale on October 5th, the payment on October 19th, and the payment on November 4th under the gross method. The gross method on October 5th will be a debit to account receivable and a credit to sales revenue of $10,000. On October 19th, we'll debit cash, debit sales discount, and credit receivables. On November 4th, we'll debit cash of $3,000 and the same for accounts receivable. We will credit it. Under the net method, on October 5th, we'll debit accounts receivables for $9,300 and credit sales revenue for the same amount. On October 19th, we'll debit cash for $67.90 and credit accounts receivable for the same amount. On November 4th, we'll debit cash for $6,000. We're going to credit accounts receivable and sales discount forfeited. As you can see between these two slides, there are different ways to record the discounts. Ultimately, our net sales revenue is the same under both methods. And that's all for this presentation. Thank you.